Welcome back. Sagility has reported a steady set of Q4 numbers. Revenue growth has come in line with the company's guidance for the year gone by. The company's organic revenue growth was above 15%. Ramesh Gopalan, MD and Group CEO of Sagility, is now joining in. Thank you very much, Ramesh, for joining in. Reema here. Now, you are guiding for mid-teens constant currency growth for the coming year with EBITDA margins of 24 to 25%. Can you tell us what's gone into your top-line guidance? How much of the existing pipeline of $575 million will you be able to convert? When does the rest come in? And what will help you push your margins above 25% structurally?
Thank you for having me on this show. Yes, we've guided to a low double-digit guidance for FY27. As I've said before, the healthcare industry in the US is undergoing a lot of change. There's a lot of cost pressure, both because of medical utilization as well as regulatory changes. And in this midst, clients are basically looking at taking costs out of operations. And that's where someone like Sagility comes in, because we have deep domain expertise. We lead with transformation, which is more AI-led. And we also are willing to commit to business outcomes. So all of this sets us up for growth. And that's what has been factored into the guidance. So broadly, some of the deals that we are working on, the timing may be a little uncertain. That's why we've given a broad range of guidance, which is low double digits. But through the year, as we are successful in closing more deals, we will update the guidance. On the margin front, we've guided to Sorry, go ahead.
No, please go ahead on margins. 24 to 25%.
Yeah, on the margin front, yes, we've guided to a 24 to 25% adjusted EBITDA margins. Again, a lot of factors go in there. There is obviously salary increments that will play out. We are also investing a lot more in technology and AI. And the Forex situation is a little uncertain. But if the FX stays in the current range, we think we can meet more towards the upper end of that 24 to 25% range.
All right. Hi, Mr. Gopalan. Good morning and good to see you. I'm looking at a couple of brokerage notes. They believe you're being rather conservative in terms of this, double-digit guidance that you've given. But we'll take that point on board. Give us a few more details. What's the new client addition you're factoring in for this year? If you could help us out with the revenue per employee. Last year, I think it was up by close to 4%. For this year, what does it go up by? And employee addition on the whole, if there is a number, if you could help us out. Please go ahead.
Yeah, so on the employee front, look, it all depends on the geography mix, right? As you know, we deliver from multiple geographies. So depending on how the revenue stacks up across these geographies, the revenue mix, the revenue per employee could shift. Obviously, tech and AI is another lever which improves the productivity of employees. So that's another reason why the revenue per employee will go up. So it's very difficult to put an exact number on the increase in revenue per employee, but directionally, it is likely to keep increasing, right? On the client addition, typically, we add about 8 to 10 clients every year. That's increased in the last couple of years. We added 17 clients in FY26. So we are looking again at double-digit addition to clients. But more importantly, the nature of work that we sign up for is also changing, right? It's no more effort-based work. There is a lot more interest in end-to-end accountability of business outcomes. And clients are looking for partners who can help transform their operations and reduce cost overall. So we expect double-digit client additions. And I forget your third question. Sorry.
It was so client addition, revenue per employee. We got both those points. Are there a number of employees as well? I think you've briefly touched upon that as well. But if you could, if you want to make a point on that front. And also, I wanted to ask you, because many believe that there is some inorganic growth in the works, and you have not shied away from that. Is there something that you could be closing out in the first half of the year?
Look, there are always deals in the pipeline, right? So we are constantly evaluating deals. So it's very difficult to give you a timing. But yes, there are a couple of active deals that we're working on. So depending on how the diligence goes, we could close them in the first half of the year. But in terms of the nature of deals, like I've mentioned before, we are looking at more capability addition. So anything that helps us in our transformational story. So anything to do with tech and AI. As well as any acquisition that will give us better market access, right? These are the two vectors on which we look at M&A. And like I said, yes, a couple of deals are actively being diligenced as we speak.
All right, actively being diligenced, and we can hear something in the first half of this year itself. On the one hand, you have client addition, which happens to be about double digit. That's what you're expecting. But a big trigger for you is getting more revenue from existing clients as well. Your top 5 clients account for nearly, 70% of your revenue. And out there is a likelihood of a 40% upside from client number 2 and about 80 to 90% upside from client number 3, 4, and 5. Have you heard from them on upsizing those contracts? And by when can we hear more on that?
So we are constantly working with them, right? So it's not a question of have I heard from them. So we are constantly working with all of our top clients and trying to figure out white spaces that we can expand into. As I mentioned, our top 5 clients grew at 11.7% year on year in FY26. And like you said, these clients account for 70% of our revenues. And the average tenure of these 5 clients is 18 years. So we still continue to find opportunities to grow with them. And we are constantly in touch with them, and we'll continue growing these top 5. But the focus is also shifting to trying to penetrate the mid and small market. So we are rather aggressive in adding to the total number of clients, and also pushing for aggressive growth in the mid market.
Okay, all right, Mr. Gopalan, final question before we let you go. Your return ratios have improved. I'm looking at your ROC. I think it's low double digit now. But the street believes that it can go to, say, 15-16% by FY28. Is that possible, the improvement in the ROEs and ROCE? And a couple of brokerage notes are factoring in that you do around 1,500 crores of net profit in FY28. It's headed in that direction?
I mean, if you can see our numbers over the last couple of years, we've grown tremendously, right? So the debt burden is going to come down completely. We are planning, all of the debt will be repaid in FY27. So given all of that, yes, the profits are likely to grow faster than the top line. But yeah, beyond that, it'll be difficult to give an exact number in FY28. But we are very bullish on the bottom line growth as well.
And the return ratios improve by around 100, 200 basis points?
Yes, likely, yeah.
15% of ROCE, that's possible, right?
That's possible.
Well, we appreciate you joining in, Mr. Gopalan. Thanks a lot for stopping by. For the time being, the street has taken heart from the commentary that you've given. The stock has moved to the high point of the day. But we've completely run out of time.